All right, well, welcome everyone. We're pleased to see a nice turnout for today, and I'd like to welcome everyone for joining us today. We've got quite a few participants from around the world, and many of you we met and were able to connect with at our recent roundtable in Istanbul. So welcome to you, and to welcome also to our new members as well. And I'd like to welcome everyone to our June webinar, Opportunities and Obstacles to Mass Market SME Credit Scoring, Unsecured Credit for Mass Market Small Businesses, presented by Michael Gallagher and John Q. Wang of Wells Fargo. If you have any technical problems during or after the webinar, please feel free to email or Skype with David Sheffick. His contact information is here. And as we normally do, we encourage you to participate fully during the webinar, and we'll be taking questions continuously via the chat box on the right-hand side of the screen or through the questions box. And I'll go ahead and read them aloud to the facilitator to respond to. And we also have a discussion section at the end, and at the 45-minute mark we will be noting that time so we make sure we have enough time for the discussion section as well. All videos, as this one, will be made available on our web community, so you're able to go back to this if you'd like to view it another time. And for our upcoming webinars, as you can see, we have a session in July on best practices in corporate governance, and this will be a continuation of our session at our recent roundtable. So this was a very vibrant discussion, and we want to make sure that we give it the appropriate amount of time. So please pass this on to your colleagues as well. In August and September, we'll be doing a two-part series on credit analysis tools. So both in terms of assessing credit worthiness of entrepreneurs and then problem loan management for SME banking. And all of these webinars are free of cost for current SBBN institutional members, and you can access the program and register online at the website. As I mentioned, videos of all completed webinars can be seen at our website as well, and we do encourage you to send out this calendar to those who you think would benefit at your institution. Now, I would like to introduce our very experienced facilitators. Michael Gallagher leads the patenting and intellectual property strategy of Wells Fargo's 80 businesses as the head of the Enterprise Patent Office. He has managed a $30+ billion loan portfolio as National Loan Products Manager, built and managed small business administration lending, and designed and managed SME credit programs. His credit training, database marketing, and general management of credit businesses have given him extensive experience in both real estate, secured, and in unsecured lending. He has expert knowledge of the improving nature of consumer credit bureaus in various Asian markets, and he has worked with credit leaders and business leaders of more than 20 non-bank and bank leaders in China, Hong Kong, India, Singapore, and Thailand. His focus has been on the consumer and SME market space. We also have John Wang, who is a Senior VP at Wells Fargo Bank. He manages credit risk policy and operations, including underwriting, account management, collections, loss forecasting, stress testing, and credit policies for business banking and business direct. He has more than 18 years' experience in credit scoring, including building underwriting and account management scores for both consumer and business credit products. John has served as consultant for many banks in China, India, and Eastern Europe. He holds a PhD in economics and an MBA as well. And so at this point in time, I would like to turn it over to Michael. And Michael, I'm not sure if you can hear me, but we're not getting any sound from you at this point in time. Michael, are you able to, I see you moving, so it looks like you're able to hear me. I'm going to unmute John as well. And John, if you're there, maybe you'd like to share on this slide. Oh, and then we can come back to Michael.
Yes. Thank you, Jessica. As you introduced earlier, Michael and I worked for many banks in developing countries, including China, India, as well as other parts of the world. Here we just listed a few firms that we have worked with.
Can you hear me?
Yes. Go ahead, Michael.
Okay.
Yes.
Great.
Thanks, Michael.
All right. Glad to be back. If I can now advance the slide, we'll be in business. Okay. So good afternoon, everyone, again. Sorry for that brief glitch. The first slide was many of the institutions that we've been in touch with about their practices and challenges. And these are the themes that we'd like to share with you today. And it's mostly around unsecured small business lending because it's a unique problem and it's a unique opportunity. There's generally too little small business lending that is unsecured in the $2,000 to $25,000 range, and that which does get delivered, frankly, is too expensive, and that pricing for risk is uncommon. Those that are in this space will charge what the market can bear, and my experience has been that banks are strongly biased against unsecured credit for mass market small business. There are a couple of banks in Asia that are an exception that have been working at it very methodically, OCBC in Singapore and HDFC in India. Non-banks are much more focused on unsecured credit, and when they deliver it, it tends to be through term loans that are paid back fairly quickly. And the fast repayment is one way to control for risk. There's almost no revolving lines of credit, which revolving lines of credit are something that businesses tend to like once they're made available and are common practice in the United States and other Western countries. Although there's been dramatic improvement in credit bureaus in some countries, those improvements have not changed lending in ways that folks that look at credit markets would hope. But data sources other than credit bureaus are being used effectively, and this is one of the themes that we want to explore with you. Those of you that know Alibaba in China, they are using sales data of small businesses who sell from their platform, and they're doing that very effectively, and will probably be one of the dominant lenders in China because of that. There's merchant advance lenders who will lend against a percentage of sales paid with a credit card, and some of you may have been seen presentations by EFL, Entrepreneurial Finance Labs, that in the absence of data, they'll create data. They'll create scores through answers to psychometric questionnaires that can assist in underwriting. And then lastly, there's the theme that when banks do embrace credit scoring, they typically do it to lower the cost of underwriting, but rarely do it or use it to price for risk, and that may be a lost opportunity. So we have a question for the participants, and Jessica, I'll turn it over to you.
Great. And so this is an opportunity for you to begin to participate. So we'd like to know who is, it looks like if we could go back to the last slide, actually, David. And so our question is if you are using not digital financial services, so I apologize about that, And so we're actually going to close this poll here because this is incorrect, and so we're going to move back to the slides. So David, if you can go ahead and close that, and we will move back to the slides. And so the question is whether or not you are using credit scoring at this point in time. So if everyone could go ahead and type into the chat box, and we'd love to know if you're currently using credit scoring, if you're in planning, or if you're not currently in planning. So we're going to take about a minute here, and we'd love to hear from you in terms of what you're doing at this point in time. So we're already getting some responses, so you can type your answer in or just the number. So thanks for the folks that have already put that in. So we'll take just about one more minute here. And I'm seeing quite a lot of folks are saying that we are in planning. And so I'd love to know if anyone is actually using the credit scoring at this point in time. So we'll take about 15 more seconds here. Great. So about 5 more seconds if you haven't typed in your answer yet. And thanks, everyone. Okay, great. So we're going to close the answer here, and boy, I'm seeing everyone saying number 2 and number 3, Michael. So it looks like we have a lot of new financial institutions who are thinking about it, either in planning or are not currently using it at this point in time. So thanks everyone who answered, and we will move back to Michael.
Thank you, Jessica, and thank you to the participants for chiming in with your practices. Now, for some reason, Jessica, I'm being challenged again to advance the slides. We don't want to talk about this for too long.
And so this would be a good time too, as we're moving forward here, to make sure if you do have specific questions about credit scoring, feel free to type those in because I'll make sure that we get those answered. So if you're in planning, what are some of your challenges? What are some of the pieces that are challenging to you at this point in time? And we'll make sure that we get those answered. And it looks like we're moving ahead.
So these are some of the opportunities that we'd like to discuss throughout the presentation. Consumer credit information for small business owners. You should be using it. Management of data, the retaining of application data, and building analytical segments. Test and learn programs, which we can talk more about, and the possibility that you might start to price for risk. Even if you don't give the customer a different pricing, you might set up a shadow pricing type of structure where you know what you could be charging and you analyze if it's less than what the market will allow you to, and you analyze the results over time. Consumer finance borrowers may be self-employed business owners, and that can be an important source of data. Transaction data to predict creditworthiness. We mentioned a few, but Ali Financial, Tencent, China Union Pay in China, and psychometric tests like EFL has. We want to tell you a little bit about how credit scoring transformed the availability of unsecured credit in the U.S. market 20 years ago. And sometimes 20 years seems like a long time, and sometimes 20 years seems like a very short time. And it was only about 20 years ago that in the U.S. Banks were not delivering loans in the range of $10,000 to $50,000. And they were almost never doing them on an unsecured basis. It was traditional judgmental underwriting with these types of characteristics of meeting customers, collecting financial information, analyzing the financial information, cash flows, leverage, collateral, and so on, and making a decision, and then reviewing that decision from time to time. And that process was a very expensive process, and is still the process that's used for larger loans today. But essentially the same process for a $25,000 loan would be used for a $1 million loan. And that would be one of the reasons that the small loans really were not cost effective to deliver. And Wells Fargo pioneered the use of the Consumer Credit Bureau of small business owners as a cost-effective way to assess risk, price for risk, and build models that dramatically lowered the cost of making good credit decisions. And these are a list of the key features of that business as we developed it. Unsecured credit up to $50,000, and a revolving line of credit that would really never have to be renewed because we could continue to obtain data from the credit bureaus and continually assess the borrower's creditworthiness. We would not collect financial statements or tax returns. It was a direct business in the early days, meaning we would go out to borrowers through the phone and through mail, and only by invitation could they apply for credit, and that was one way to control for adverse selection. And it was a one-page application, similar to what a credit card application might be in the consumer space. We put that on a consumer loan platform, which was cheaper than a commercial lending platform, and we would issue a book of checks and a credit card as a way to for the customer to use that product. Although if they were deposit customers, they could also access a line of credit through telephone and internet banking. And the pricing would be between 5 and 12% over the cost of funds, and risk adjusted, and intentionally a little bit cheaper than business credit cards to make it an attractive working capital product. And that became a very large profitable business for Wells Fargo. It's called Business Direct, and it's probably the most important business over the past 20 years that positioned Wells Fargo eventually as the largest small business lender in the United States. And I'll hand it over now to my colleague John Wang, who will talk more about some of the details of credit scoring.
Thank you, Michael. I'm going to talk mainly about the scoring, credit scoring for small business. Here is a brief introduction of how the credit score applied in the United States. As Michael mentioned, it started about 20 years ago. For credit score, first thing I want to stress is it's mainly a number trying to rank these customers compared to the population in your customer database. The two most important components in a score is data and the algorithm. One thing I want to stress here, which is related to data, is the Fair Credit Reporting Act. This is a law governing the collection and reporting of consumer credit data. And this law actually lays the foundation for accuracy and the scale of today's credit bureau reports. Before, as Michael introduced earlier, before the wide adoption of credit score in 1980s in the United States, human judgment was a sole factor in underwriting decisions as well as account management. It worked well, but it was slow, unscalable, inconsistent, opaque, and expensive. Those are the problems the credit score trying to solve. In early days, expert judgment was used based on a point system, and the point system is mainly based on the information collected in credit bureau. And it was later, I would say somewhere 15 years ago, the statistical models become widely used for credit scoring and credit decision. As Michael mentioned, that credit score application in small business actually was pioneered by Wells Fargo in late 80s, and that application actually led to the creation of Business Direct. Michael, next page. I do want to emphasize the data and the algorithm because there's a lot of new development in those two critical components. Historically, we use conventional data to build the score. Conventional data includes mainly credit bureau information credit applicants entered into our application system, the existing bank relationship a bank has with the borrower, as well as public records and transactions the bank has. And those data typically is in a structured and relationship form, is easy and ready to use. Unconventional data, mainly referring to sometimes called big data. And there are a lot of information. These are introduced and created from this internet revolution. Internet ID, which covers employment, education, social activities. Those typically are information you can get from social network websites like LinkedIn or Yelp. The challenge there is typically this data are unstructured and unrelated, but they are very, very powerful to help make credit decisions as well as credit scoring. As for the algorithm, historically the algorithm is statistical regression, typically logistic regression, as well as the point-based expert judgment I mentioned earlier. The new advancement here is artificial intelligence, sometimes is called machine learning. It's basically training the computer to be intelligent, to be able to select good credit applicants from bad. From the on the data set to help solve the unstructured and unrelated data problem, there's a natural language processing developed. It's mainly try to extract text or words from different website. Next page. Here is a landscape of small business in United States. Small business is very, very important for the country. It produces about 40% of the U.S. GDP. As for the employment, it actually employs more than half of the country's workforce. So it's very critical to the economy to help the small business develop and grow. You can see that there's about 10 million business are small, 12 million are pretty much part-time business. actually this is macro, and think about 5 million, these are called small business. Typically employment is 1 to less than 20 employees. With this size, once we are talking about 15 or 20 million small business, it will be very hard, very expensive, and very inefficient to lend to this small business using the conventional judgmental system. So that's where the credit score has to be used in order to provide credit to these small businesses. Next page, please. Next page. Here are typically elements or inputs used for a small business card. In judgmental business, we're typically talking about the 5 critical components for underwriting. In English, we call it 5 C's. These are character, capital, capacity, collateral, and conditions. And since we are talking about mainly unsecured, so the collateral is not a main factor, but all the others are key factors for underwriting. And here, all these inputs are trying to capture these 4 C's. For example, the personal credit information of the owner. Here we use their existing outstanding debt, how they deal with their existing debt in terms of regular payments, whether they have late delinquency in their credit history, as well as their mortgage information, their auto loan information, how they utilize their personal credit, and whether they are seeking new credit today. All this information are important both from capacity perspective and character perspective. And in fact, the main reason we look at how the owner deal with their personal finance is trying to evaluate the character of this borrower. And on the business side, we look at years in business, how long have the potential credit customer have been with the bank as a banking customer, mainly on the deposit side. The average deposit balance, the turnover of the business, and whether the business have other source of income, including the household income, spouse income, investments, etc. And also we look at the credit trade information the business already had. These are an evaluation of the capacity of the business, how much debt they have and how much new debt the business can sustain. We also look at the industry and the geography location of the business because these are 2 very important factors in evaluating the condition of that business. One example is back in 2009, 2010, even for a borrower who have been successful, but if they are a residential housing developer, and when we have a really bad housing recession, and we are very careful in extending loans to those customers. I'm talking about residential house developers or contractors. Next page.
So Jessica, we've got another question.
Great.
So
Okay, so we have another.
It occurs to me, Jessica,
can you hear me?
can you hear me?
Yes, I can.
It occurs to me, since we heard that folks are folks on the line are mostly considering using credit scoring, maybe we should go past this question, since we're asking them if they're using different scoring for different types of credit.
Sure. Yeah, that's fine. That's fine. So we will move past this poll and continue on with the presentation.
John, back to you.
In the United States today, and you can. Hello.
Yes.
Hi, we can hear you now. We're just having a couple audio issues there.
Keep going.
Okay. Here I separate the business by the size: small, medium, and large. And the total outstanding in lending size in the United States for small business is about 100 million. For medium, it's about 400 million. And for large, this is about 2 trillion. In terms of number of potential borrowers, small business has about 15 million. The average exposure is somewhere between less than $100,000. And in this space, both judgmental credit as well as score are used, but on the lower end, typically it is less than $50,000. It's mainly based on a score decision. And score is also used for managing the account as well as for collection. For the medium-sized business, which we have roughly 500,000 customers, in Wells Fargo, this is an area mainly dealt by business banking, and here the underwriting decision is mainly based on judgmental credit analysis, but the score is used in underwriting on the smaller deals, and it is also a very important tool for account management. For large business, credit scoring is pretty much not used. Next page. Some of the challenges and opportunities I see in working with banks as well as non-bank lenders in developing countries, I would say the most critical challenge is data. The first challenge of data is the accuracy. In the United States, I talked about the Fair Lending Act, and pretty much the collection, reporting, as well as accuracy of the data are protected by law. So the accuracy is, to some extent, given in our credit bureau information. In many developing countries, there's no legal protection on consumer information as well as the business information. So that's the accuracy of the data definitely is a challenge. And also the availability of the data, because when there is no legal requirement, the reporting by the lender is not required. Therefore, some lenders may choose to report their borrower.
We just lost you a little bit there, John. The last couple
some lenders are not. Can you hear me now?
Yes.
Okay. Another challenge with small business is very diverse by industry, region, as well as if it's secure, the collateral type. So the data is very complex. The last challenge, which is not the least challenge, is typically for small business borrowers, the sample size is small. And in order to build a good statistical model, we need a sizable sample size to make the statistics significant. There's a few solutions to solve these problems or challenges. Michael will mention pulling the data. In the United States, we have a small business financial exchange. It's basically member-owned, not-for-profit, small business lending information sharing association. A lot of banks contribute to that small financial exchange, and then use the data there together. So that's one solution to the data challenge. Another one is using expert judgment to build a point-based system, just like the early days in the United States. For any financial institution, if they are making lendings to small business today, they must have some people follow certain rules to extend the credit. And we can interview those experts based on their knowledge, and create an expert judgment system and use that to rank the borrower. And at the same time collect the data when the data is available, and then build the statistical model. The last one is, as I mentioned earlier, there's a lot of unconventional data available on the internet, and leverage this internet may speed up this credit scoring process in your country. Michael, I will pass it back to you.
Good. Thank you, John. I'm going to show a couple of quotes here and comments about that I gathered from interviewing credit managers and lenders in a number of the Asian developing markets. That the personal credit bureau, even though it has improved and it's being used, it's now a factor in many lenders' underwriting. The lenders are still worried about what's not being reported to the bureau, so undisclosed debts, and the issue of a clean credit history, that may not be keeping one's credit history in good shape, may not be a sufficiently strong motivation to have borrowers perform. A legal system being hard to use as a lender to support collection of debts, and since that varies from country to country, that can be a major factor. In countries where the credit bureaus are improving, but are still limited and developing, the fact that someone has no or limited credit history in the U.S. market, that would be a reason not to lend to them because it'd be high risk. But in many developing markets, you couldn't stay away from, if you wanted to have a viable business, saying you'll never lend to someone who doesn't have a credit history may be a rule that keeps you away from too much business you could be doing. And since we're talking about unsecured lending, since every 5 to 10 years there tends to be a very ugly development in high losses in unsecured credit portfolios, whether they be consumer or small business. You can always find experienced lenders who will say that this is a dangerous type of lending to be doing. Some of the things that we did encounter when unsecured lending is taking place at significant levels, particularly in China and India, it's been by non-banks, and that the process on a composite basis looked like a high-touch process with customer interviews, reference checking with customers and suppliers, and essentially the bank creating a financial picture from that process, since they couldn't rely on the borrower's description of how the business was performing. And always reviewing several months of bank statements. You sometimes find the loan originators also responsible for collections as a way to build in some accountability. And even if it's unsecured lending primarily, you'd often see the lenders taking any available security or collateral to prevent the borrowers from using it for additional borrowing with other lenders. A lot of these approaches have a social connection where the loan originators are active in the borrowers' networks, and they see these borrowers regularly, so that there is some social pressure to be repaying. And there's also the tactic that is sometimes used of the lenders requiring several guarantors among family members. And as I had mentioned early on, short terms are one way to control risk. So a one-year loan is probably the most common, and 3 years is a long-term loan. And the lenders that are doing this business are having quite high margins and surprisingly low losses, at least in the past several years. Low losses considering the types of margins that they get paid on these loans. And then I think these are some of the questions that may be helpful as we go into the discussion phase. Do you price for risk? Do you have a test and learn process? And maybe if you don't, starting to think about, if you had budget, capacity, and power, what would you want to test and learn? And in the area of discussion, since scoring, unless you start with the expert score approach, which John mentioned, to do a statistical score does require volumes that small lenders it's almost impossible for small lenders to have within the walls of your institution. So how can a lender who has small numbers of borrowers perhaps benefit from credit scoring or participate? And there may be some pooled data approaches with other lenders that may be worth exploring, as well as looking at consumer and credit card portfolios. And lastly, since there's a variety of countries that you are from, you'll know much better than we would know whether or not the credit bureau, the consumer credit bureau or business credit bureau in your country is functioning well, if it's negative information only or if it's positive and negative, what the rules are. But some credit bureaus have developed generic scores, and that represents an opportunity to use the bureaus in a way that when a generic score has not been developed yet, it essentially leaves lenders to having to develop their own scores. And then lastly, there are professional corporations out there that are expert at using credit data and other sources of data. We list a few of them there. And they may be in your marketplace, and they may be willing to work with you in a cost-effective way, particularly if you want to team up with other lenders in your marketplace. So Jessica, why don't I hand it over to you for facilitation.
Great. Excellent. Well, we've already had a few questions coming in, and so this would be the time to go ahead and type in your questions directly into either the question box or the chat box, and we'll monitor those. And so we had a couple questions come in directly about the challenges that we've seen for the institutions that are currently planning to use credit scoring, and the big issue that we're seeing at most of the institutions is lack of good data. So, you know, for one of the institutions, their main challenge is getting historical data, and you know, they're on the customer's cash flow, and they currently have some good transactional and demographic data, but not enough data in order to, you know, build the credit scoring. So I know that both John and Michael discussed a couple options there, you know, in terms of pooling some data and a point-based system. So maybe you can talk to us a little bit more about how to build some of this data, and you know, whether or not one of these tools might be the right one to use.
And I'll turn it over to John, who's the real expert on these different approaches.
Thank you, Michael. Even today in Wells Fargo, we are still using some aspect of expert judgment, and this judgment are pretty much rules developed by our lenders over many years lending history. Typically, information used there, including the credit bureau information, but most importantly is the financial information we collect from the borrower. I'm talking about the application in business banking. Basically, this is more for medium-sized business. So we do collect financial information. We do from time to time require collateral, and the information we collect there actually is evaluated through a borrower quality rating, which is expert judgmental system, and we make a point for each borrower. I think that for developing country, basically for your country, especially if you don't have long history and if you don't have enough sample size, one of the practical solution at this moment is to develop an expert judgment system to assign a point to the borrower. The good thing about the expert judgment system is that you can twist it quickly and based on the feedback from your lender, as well as the effectiveness of this expert judgment system. Another thing I want to point out is that in my slide about the credit score, I stressed that the credit score is mainly a ranking tool. It's pretty much rank the applicants. It gives you a number, so you can rank these applicants against the population in your lending space. It is not a number that you can gauge a probability of default or probability of loss, which is really what you need to price for risk or to make your final lending decision. And in order to get that number, you need a good data from a historical perspective as well as good size. Even in the United States, to get a good estimate for a borrower, say what's the likelihood of charge-off.
We lost you for
John, you're breaking up just a little bit for us.
My stage and hey, Jessica.
Yes,
yeah,
we hear you now.
Now you sound better. We lost you for about a sentence.
What I'm trying to say.
Yeah, let me ask John because I think it may be interesting for folks that are participating. If they were to start, if a bank were to start to develop an expert point system, I'm assuming that if they had a 100-point system or a 20-point system, and they started to assign points to the attributes of their better customers at the time of application, and then over time, they might come up with a type of test score where they'd say a customer that looks like this, that's been in business for so long, that has, doesn't have all of its sales in the hands of just 2 customers, but has them spread across numerous customers, quality of financial statements, character references, so on. You might come up with a system. Let's say if it's a 20-point system, say we don't lend to anyone that has a score of less than 11, and you come up with something like that, and you start seeing if the score is accurate. If you start applying it to like you see what a score would what a new applicant score would look at, but then you'd also have an expert evaluate the information in a detailed way and say, oh, I think even though the score says this is a good customer, I don't think it's a good customer, and here's why, and you'd make adjustments in your score. Is that the type of methodology that a credit department would start to develop?
Yes, at the starting point, that's exactly how it is used. And once you trained your expert judgment system and you feel comfortable with it, and then you can use it to make basically as a sole decision to make a lending decision for your best and worst applicants. What I'm trying to say is that maybe for the customers ranked top 20% of your application pool, you can say that based on the score, I will make a loan or give the customer a revolving line. And for the worst 10%, I will decline them right away. And then for those applicants in between, I will have a lender to make a judgmental decision. And that lender decision space can gradually be reduced once you improve your expert system and feel more comfortable with that. And over time, once you collect more data, and you can then apply statistical methodologies there, and then the system will become a combination of expert judgment system with your statistical credit scoring, which further empower the credit scoring system.
I think that's helpful.
Great.
It was helpful to me
Great.
to hear it explained that way.
Yeah. And actually, we're going to unmute one of our participants. So Syed Abdul Momin from BRAC Bank, because he had a quick follow-up question. So we'll see if this works, because it's always fun to have our participants join in from all of their different locations as well. So can you hear us, Syed?
Yes, I can hear you, Jessica. Can you hear me?
Yes, we can. So if you'd like to ask your quick follow-up question to both John and Michael as well on this.
Yeah, actually, before asking, I'll just give you a brief about BRAC Bank. Like in John's slide, there was one slide where he mentioned that a bank which processes 1,000 loans per month, actually, and so we are that kind of a bank. We process around 5,000 loans per month, and we say approve around 3,500 loans per month. And all are small ticket loans, and it matches exactly the things that you said. Like these are all our interest rate is around 22%, and actually these are small ticket loans, and our loan officers, they do collections, and it's a highly supervised credit. Like for each credit decisions, the senior credit manager visits each and every proposal. So this is kind of a model we are in, and as I can see that from the discussion, that expert judgment model would be the best fit, because we don't have the historical dependable data. We do have the transactional data and demographic data, but we don't have like say for customers cash flow data. Those are not reliable, whatever we have the historical data. So for like my question would be like in this kind of a situation, if we want to develop an expert judgment model, it's like then what would be the steps to begin with? Like at first, what we should do and where to start? Actually, that is exactly to be precisely my question.
I'm going to jump in and just add another question so we can get a couple other ones in there. Is what is the amount of data that an institution needs as well? So we had an institution ask whether or not they've reached sort of their critical mass, if they have enough data at this point in time. So as you're talking about, sort of these first steps, it would also be great to hear, how much data an institution would need as well to put this together.
And I just like to chime in before maybe John gives a little more of the technical. The gentleman from BRAC, I know that BRAC is very well understood and heralded throughout the developing world for its ability to lend and have to have grown over time, and the types of numbers that you mentioned begin to present a data opportunity that does lend itself to the development of statistical scores in addition to judgmental scores. So I don't know what data you're creating and keeping and trying to build up a treasure chest of data that can be harvested over time. But John may have some initial suggestions for how to get started if you've not already gotten started.
And John, we can't hear you, so I'm not sure if you're having technical issues, but are you able to provide any more insight on putting together this this model?
John may have a couple of issues, but I know in the work that I was doing with lenders in China recently, I was excited by the data that they could have, but that they were not yet collecting systematically. And so I'm not assuming that I don't know what BRAC is doing, but in the
actually, I would say our position is exactly the same.
Okay.
We have a lot of data, but those are all in in the loan application form, and the and the data that are in the loan application form are not digitized.
Right. Well, you are not very different from how Wells Fargo was 20 years ago, when Wells Fargo started to work on developing credit scoring methodologies for small business. We had many months of a project to go and get data off of paper applications and some loan systems, and to turn it into electronic data that could be used effectively. So I know we can't go too deep right now, but I do think that the quick answer to building statistical credit scores is that you want to have at least 1,000 good performing loans, and you'd like to have 1,000 bad loans, and bad can be described as having been delinquent at various periods of time. 60 days is certainly bad enough to begin to have enough bads, and you also want to have rejected applications. That's a starting point for a good data set. And any one of these companies, Experian, Fair Isaac, TransUnion, even if you didn't want to work with them, you might want to meet with them to get a proposal for how they would go about working with you, what the work plan would look like. And in some ways, there's no time like the present. You may have enough data around that you could have a short-term project to translate it into data elements and start using it experimentally and improving it over time. If for other lenders that don't have the data around, but you want to start thinking about how to start capturing it and keeping it so that you are in a position in a year or 2 years to start using that data more effectively.
Great. Thanks, Michael. And we're going to take about 5 more minutes of questions, so please keep them coming in. And Michael, if you want to hide that, try not to restart your computer, if that's okay.
Yeah, that's a good idea.
Perfect. I just want to make sure we don't lose everyone here. And hopefully we'll have John back in a moment. But a couple other questions that we had coming in terms of another challenge is the technical skills within the company. So I'm thinking about that both as the IT pieces as well as the human capital piece as well. So could you talk to us a little bit about what the team would need to look like to put together this credit scoring as well as to manage this credit scoring, and also what would be the back office kind of support that's needed for this as well?
Mm-hmm. I don't know if John has rejoined or not. That's a very good question. Excuse me. And our experience has been over the years that the development of expert scores and the development of statistical credit scores is best done when there's a combination of historical credit folks with a couple of individuals that really are mathematicians, statisticians, data people, and both are needed in the process. And that the traditional credit people will typically be a little bit skeptical of the data approach, and the data math folks won't have typically a real-world understanding of important credit factors. So both tend to be needed. There is a danger. I mean, when we go into large institutions that haven't been developing credit scores for small business, it's probably the case that there are some people in the credit operation on the consumer side that do have the skill set that is more statistically and data oriented. So in some ways you can go look in credit card risk type operations and sometimes find people. What you do want to be careful about is if you use consultants, we always kind of give the warning that you do want to have someone who's on your credit risk team that has a good enough background and understanding to I guess challenge and use and not just accept as authoritative what the consultants propose, because if you use Fair Isaac or TransUnion or Experian, I think they can do very good work, but they will not be there later to guarantee or adjust the results of your performance. So I think consultants can help you a lot to advance your work, but you should have a couple of people on your team that have a math statistical data type orientation, as well as some crusty old credit person who's open to this approach and learning from it, but helps to keep it grounded in reality.
Yeah. Hey, Jessica, can you hear me?
Yes. Hi, John. Thanks for joining us again.
Yeah. Sorry. Just want to chime in on what Michael just talked about. I think that in terms of the expert judgment is universal. So I think getting expert consultant to provide help, that's very, very useful. Secondly, specific to the question earlier on the expert judgment, the typical process happened in Wells Fargo is that we interview the experienced lenders and basically write down the key factors they use to do the underwriting. At the same time, we also research the industry and basically trying to get the overall learning from the industry and combine those two things together and list the most critical factors for making the right lending decision, and then put the weight on each factors. That's how we build our first quote point system. Earlier you mentioned that you have on a monthly basis you have about 5,000 applicants and you approve 3,500. That sounds a very good size of the for building statistical models. But I do understand that currently your data is on the is more like the loan documentation is not collected in a database. And that's a typical challenge. I think that there's a few ways to solve this problem. One is that once you identify the most critical factors, you have some people to pencil through all these loan documents and collect those most important piece of information, and then try to build statistical model based on that. Another way is that leverage some technology. There are some crawler you can use, and basically automatically go to your loan database and go to each loan documentation to collect information for you.
Right.
Yeah, from technical perspective, that's are a few things I can think of at this moment.
Great. That's very helpful. You know, we are running out of time, so I'm going to combine a couple questions here. And, you know, I think some of the questions come in, when is it an appropriate customer or business to use credit scoring? So is it appropriate to use credit scoring for fully secured customers? And also, might you use credit scoring for newer businesses, for newly established businesses? And so if you could talk a little bit about when and if that might be appropriate, and you know, what would be the terms for using it during those times?
You still there, John?
Yes, I'm here. Jessica, I lose a little bit when you're talking about newer business, but I think I got the idea. In fact, that in my slide I talked about character, and for newer business, and particularly if they are borrowing on the smaller size, the main decisioning information are based on the owner's personal information. And in fact, that's how Business Direct started up. For Business Direct, the main decisioning point is the owner's character, is the owner's capacity, owner's basically the owner's capital and the owner's asset level. So that's one piece. Especially this is true for new business. As for the secured, yes, we do use credit score for the secured borrowing. That's where the collateral get into play. That's where the CQR, the collateral quality rating, get into play. The collateral or security piece mainly help to determine when the borrower, when it goes into default, what kind of losses will the bank, incur? Because if it is cash secured, once the loan goes to default, the recovery rate is 100%. So, even the borrower not paying you, you wouldn't lose money. Same thing applies to real estate lending. If the LTV is less than loan to a value of the collateral is less than 50%, it's very, very unlikely you will lose money. So those needs to be in the consideration when you build your credit score, as well as when you make the judgmental lending decision.
Great. It's very helpful. I'd like to thank our facilitators. I'd like to thank our presenters, both John and Michael. And we have about 4 or 5 more questions that we did not have time to answer. And so what I'd like to do is we will post 1 or 2 of the best questions on our LinkedIn page. So if you've not followed us on LinkedIn yet, please join us there. And so if you, as an FI, has an answer or have encountered this issue, please do respond to that. And I'd also like to ask John and Michael to chime in if they're able to do so to answer a couple more of these questions. And also, if you do have a specific need for some of the credit scoring that we talked about, that is one of the areas that SBBN works on in terms of the capacity building and technical assistance. So please feel free to get in touch with us directly if you have some needs in terms of some of the credit scoring development that we discussed as well. So again, thanks so much to everyone, and thank you to both John and Michael.
Thank you.
Thank you,
Good luck to
Jessica.
everybody.
Thank you.